Daniel walked into the bank thinking he was about to build his future. He had a stable job, he had good income, he had a decent credit score, and he had an idea. He wanted a small loan to start a simple service business on the side. Nothing crazy, not a mansion, not a luxury car, not a vacation, a business. He wanted money for a basic website, equipment, software, marketing, and a few months of breathing room while he built the first customers. He had already tested the idea, he already had people interested, he had already made some money on weekends. He was not asking for money to look rich. He was asking for money to build something, but the bank said no. They wanted business history, they wanted proof of steady business income, they wanted collateral, they wanted documents from a business that was still new. So Daniel left disappointed. He felt like maybe he was not ready, maybe he was thinking too big, maybe he should just stay in his lane. Then a few weeks later, that same bank sent him a message. He was pre-approved for a car loan, a much bigger amount than the business loan he had asked for. No business plan, no customer proof, no wealth building strategy, just his salary. The bank would not help him build an asset, but they were ready to help him buy a liability, and that is when Daniel started to understand the game. My name is Edwin, and welcome to The Wealth Shift. Today we are talking about how banks found the perfect way to keep people broke, not by forcing anyone, not by locking the door, not by stealing money from your account, but by making debt feel normal, payments feel affordable, and ownership feel harder than consumption. And before we go further, let's be clear, this video is not saying every bank is evil. Banks provide useful services. Loans can help people buy homes, start businesses, manage emergencies, and build real assets when used wisely. Debt itself is not always bad, but the problem starts when you are trained to think like a borrower instead of an owner. The problem starts when every financial decision becomes, can I afford the monthly payment? Instead of, will this make me wealthier or more dependent? That one question can change your whole life, because banks do not need you to be poor. They need you to be predictable. Predictable income, predictable payments, predictable debt, predictable behavior. If you have a job and a salary, the system can measure you. It can decide how much house you can afford, how much car you can afford, how much credit card limit you can manage, how much personal loan you can carry. Everything is built around your current income, not your future potential, not your business idea, not your ownership plan, your current paycheck. And that is where the trap begins. Because once your salary becomes the measuring stick, your lifestyle starts expanding to the edge of that salary. You get a raise, the bank offers a higher limit, you get promoted, you qualify for a bigger car loan, your income improves, your approved mortgage amount increases, and slowly your income does not become freedom, it becomes permission to borrow more. That is the quiet trap. Most people do not stay broke because they earn nothing. They stay broke because every increase in income gets converted into a larger payment, a better car payment, a bigger rent payment, a larger mortgage payment, more credit card spending, more buy now pay later plans, more subscriptions, more lifestyle obligations. The bank says approved, and approval feels like success, but approval is not wealth. Approval means someone believes you can carry the debt. That is different. If someone approves you for a loan, that does not mean the loan is good for your future. It means the payment looks profitable and collectible from their side. That is why you must think differently. The bank asks, can this person pay us? You should ask, will this help me build wealth? Those are not the same question. A car loan can be approved because your salary supports the payment, but the car may lose value. A credit card limit can be increased because you have a steady income, but the balance can trap you in interest. A personal loan can feel like relief, but if it funds consumption, it may only delay the pain. A mortgage can help you own a home, but if the payment stretches you too far, the house can become a financial cage. Again, the issue is not that every loan is bad. The issue is whether the debt helps you own something valuable, increase income, reduce future costs, or build stability. If it does not, it may simply be a more comfortable trap. Now compare that to wealth building capital. Money for a business, money for equipment that produces income, money for skills that increase earning power, money for assets, money for ownership, money for something that can eventually pay you back. Suddenly the process becomes harder, more questions, more documents, more proof, more history, more risk checks. And some of that makes sense. Business is risky, banks have to protect themselves, but the lesson is still important. Consumption debt is often easy to access because it keeps you tied to your current income. Wealth building capital is harder to access because it depends on future value, and future value is less predictable. That means if you wait for the bank to approve your future, you may stay stuck for years. Daniel learned this the hard way. The bank would not fund his business, but they would fund a car. They would not fund something that could increase his income, but they would fund something that required monthly payments from his income. That is the difference between being financed and being freed. A financed lifestyle can look successful from the outside. Nice car, nice apartment, nice phone, nice furniture, nice vacations. But underneath, everything depends on the next paycheck. Miss one paycheck, and the whole image starts shaking. That is not wealth, that is leverage. Wealth is different. Wealth gives you options. Wealth gives you ownership. Wealth gives you breathing room. Wealth gives you the ability to say no. Wealth gives you assets that work even when you are not working. The banking system becomes dangerous when it makes leverage feel like progress. You feel proud because you qualify. You feel responsible because you can make the payment. You feel successful because your lifestyle improved. But if your assets are not growing, if your cash flow is not improving, if your ownership is not increasing, you may simply be upgrading the cage. This is why monthly payment thinking is so powerful. A $40,000 car sounds expensive, but $650 a month sounds manageable. A $6,000 vacation sounds reckless, but monthly installments make it feel normal. A $2,500 furniture set feels high, but only $99 a month feels harmless. That is how big decisions become small payments, and small payments become a heavy life. One payment does not feel dangerous, but 10 payments can quietly steal your future. Car payment, phone payment, furniture payment, credit card payment, personal loan payment, subscription payment, buy now pay later payment, student loan payment, mortgage payment, insurance payment. By the time the paycheck arrives, most of it already belongs to someone else. That is how people become employees of their own lifestyle. They work all month, but the money is already assigned before they touch it. So what is the way out? First, stop confusing approval with progress. Being approved does not mean you should say yes. It only means someone is willing to sell you debt. Before you accept any loan, ask, does this help me own more? Does this help me earn more? Does this reduce a necessary cost? Does this protect my stability? Or does it only help me consume sooner? Second, stop asking only, can I afford the payment? Ask, what is the total cost? Ask, what does this payment stop me from building? Ask, how many months of freedom am I trading for this? Ask, will this still feel worth it 1 year from now? Because affordability can be a trap. Something can be affordable and still be financially unwise. Third, build your own capital. If banks make it hard to fund your future, start funding it yourself. Create a business fund, create an investment fund, create an emergency fund, create a skill-building fund. Even if the beginning is small, you are training yourself to become a capital builder instead of only a payment maker. That shift is powerful. Fourth, use your salary as a tool, not a ceiling. Your salary is not your worth. It is just the current price someone is paying for your time and skill. Do not let that number define your imagination. Use the paycheck to buy freedom. Use it to pay down bad debt. Use it to build assets. Use it to learn. Use it to test small business ideas. Use it to create options outside the paycheck. Fifth, understand the difference between using banks and needing banks. Wealthy people may still use banks, but they use banks strategically. They use credit when it helps them grow, protect liquidity, buy assets, or manage timing. They do not use debt just to prove they can afford a lifestyle. That is the goal. Not to hate banks, not to fear credit, but to stop being trained by debt. Now let's go back to Daniel. He did not take the car loan. He kept his old car. He kept his job. He built the business slowly on nights and weekends. It took longer than he wanted. He had to save from his paycheck. He had to start smaller. He had to learn marketing. He had to reinvest profits. He had to say no to lifestyle upgrades. But after a year, the side business was real. After 2 years, it was producing serious income. After 3 years, Daniel was not begging the bank to believe in his potential. He had built proof. And when the bank finally wanted to offer him bigger services, Daniel understood something. The goal is not to wait for institutions to give you permission to build wealth. The goal is to become the kind of person who builds capital, owns assets, controls spending, and uses financial tools wisely. That is the shift. Banks found the perfect way to keep people broke by making debt feel like opportunity. But you can break the pattern. You can stop measuring your life by what payments you can afford. You can stop letting your salary define your ceiling. You can stop turning every raise into a larger obligation. You can stop financing a lifestyle and start funding ownership. Because the real question is not, what can I borrow? The real question is, what should I build? This video is for education only and is not financial, legal, tax, banking, or business advice. Debt can be useful or dangerous depending on the situation, so make decisions carefully and seek qualified guidance when needed. We post a new video every day on the Wealth Shift, So subscribe for everyday financial lessons that help you avoid money traps, build better habits, and grow real wealth. Shift your money, shift your future.